Now, the way that works is once you breach that level, the top of the lip of the cup, the $50 level, first of all, there is no resistance at all. But the way technical charting would work is that you take the difference between the top of the cup and the bottom, which is approximately from 50 to 4, about $46. You would add it onto the top, and your next target upside would be $96, 96 to $100. Is that crazy? No, it's not. I mean, triple-digit silver is something one could expect at some point. Well, I mean, it's physical demand coming into the COMEX, coming out of London, coming out of Switzerland. The demand is off the charts. The lease rate in London, which is typically 0.5%, rarely gets above 1 or 1.5%, even in times of stress, and then it would typically only be for a short period of time. The lease rate is the rate at which it would cost to borrow bars to short or to cover a position, is as high as between 5 and 6.5%. And that's an anomaly, to say the least. It signals great tightness inside of the market at the highest of levels. The amount of silver that's coming into the COMEX is off the charts. From a technical formation, you have a 45-year cup and handle that might be as powerful of a formation as you will ever find in technical analysis, especially one that is mature as silver. 45 years, and the way that it works is the beginning of the cup would have been 1980 at $50, and then it goes down to the bottom, the shape of like a bowl or a cup, to $4 or thereabouts in the early 90s, and starts to come back up to 2011, almost to the top of the cup. Doesn't preach it, comes down in consolidation for the handle, and here we are at basically $44, very close to moving back up. Now, the way that works is once you breach that level, the top of the lip of the cup, the $50 level, first of all, there is no resistance at all. But the way technical charting would work is that you take the difference between the top of the cup and the bottom, which is approximately from 50 to 4, about $46. You would add it onto the top, and your next target upside would be $96, 96 to $100. Is that crazy? No, it's not. I mean, triple-digit silver is something one could expect at some point. And then when you realize that the government reclassified silver now as a critical element, a critical mineral, they've put a floor under the price of silver. And so I think, all of the talk over the last 6-7 months, and I said no from the get-go, this is not about tariffs, never was. It was a ruse to bring it all back. This is reshoring. This is understanding that the biggest money in the world understands the significance of things like silver. The biggest traders here in the United States, the institutional traders, when they start to pay attention, when they start to accumulate, we should all pay attention. We've been talking about this on a central bank level for a few years now, about the deliveries into COMEX for a few years now, about the accumulation by India, by Russia, by Saudi Arabia, by China. China flying around the world and buying doré when they're the second largest producer in the world, sending it back to China for refining. Why would the second largest producer of silver in the world find it necessary to fly to Latin America to buy concentrate and doré directly from a miner, pay double what the West will, ship it back for refining if it were just this, this rock that hasn't done anything forever? And I don't know, silver right now feels to me like gold did about a year ago when it was right in the $2,100, $2,200 range, and it kept trying to break out and would, consolidate and try to break out, come down, consolidate, in a long period of consolidation, and then broke through, and it hasn't looked back. I would say that's about where silver is right now. I look at it as the most undervalued asset in the world, and now evidently the United States finds it significant enough to call it critical. I think there are very few opportunities asymmetrically where you have such low downside and such high upside being asymmetrical. For an asset like this, it's once a generation. So I think the drivers are big money waking up. Now, you could argue that the public is not even part of this rally yet. What happens when they collectively wake up? This is being driven by people at the highest of levels before the public catches on, which is another contrarian indicator. So, yeah, I think what's driving gold and silver is that silver is finally catching up. Gold is being rewoven into the monetary fabric of the globe. And thankfully someone in this administration, I think, grabbed President Trump and said, if we don't do this, we will forever regret it. This is our last opportunity to bring some of this home, because the world is moving away from treasuries and dollars and paper promises. And then you add on to it sanctions and tariffs. After 4 years of nightmarish domestic and foreign policy, prior to this administration, you could argue a system that is fully based on trust has squandered the majority of it. And then, look, I would vote for President Trump again, but I don't agree with the way he is antagonizing even his allies, like India, as an example, throwing on 50% tariffs, and many of the other countries in the European Union and Canada. Maybe there's something bigger at play, which we've talked about a lot, but I think it's just beginning, quite frankly. Look, you have a comment coming out of Goldman Sachs a couple weeks ago that if the market even thinks that the Fed has lost independence, well, okay, the firing of Lisa Cook, who's going to go in there? It'll be a Trump bobo. You look at Stephen Murin replacing the last Fed official who left, who is the author of the Mar-a-Lago Accord. The Fed has lost independence. And mind you, this is nothing new. You go back through history, you'll see this happening with multiple presidents, but it's like they give you crumbs and the crumbs, well, we told you that this could happen. And now you have, banks talking as high as $6,600, 4,000 being base case for most of these banks. Look, you put silver at 5,000, like Goldman says, and divide it by 70, which would be, way higher than its average for the past 100 years, and still 10 times higher than it's coming out of the ground at. You're talking $75 silver or thereabouts. So, to me, this is just beginning, Elijah. Honestly, I do believe that, and I think this is the time that most of us have been talking about, as typically following suit way early, but I'd rather be months and even years early than 60 seconds late when the switch flips on this.
The way I see it, what we're watching right now is nothing short of historic. It's not just about price moves on a screen. It's about the tectonic plates of global finance shifting under our feet. And if you've been paying attention, if you've been stacking, you know exactly what I'm talking about. Look at silver, the demand coming into the COMEX, coming out of London, coming out of Switzerland. It's off the charts. Physical bars are being vacuumed out of the system, and the lease rate in London tells you everything you need to know. Normally, the cost to borrow silver bars for hedging, for shorting, for covering positions sits around 0.5%, maybe 1% in times of stress, rarely 1.5%. Today, 5 to 6.5%. That's not a signal. That's a siren. That's the market screaming, we're tight, we're stressed, we're running out. Add to that the chart formation. You've got a 45-year cup and handle pattern in silver. Folks, this is as powerful a technical formation as you'll ever see. The cup starts at $50 in 1980. Silver collapses down to $4 in the early 90s. Then it grinds back up, reaching almost the rim in 2011 before retreating to form the handle. And here we are today, back near $44, on the verge of retesting that $50 level. What does technical analysis say happens next? You take the depth of the cup, $50 minus $4, about $46, and you add it to the breakout point. That gives you a target of $96. Triple-digit silver is not a fantasy, it's math. And here's the kicker. The U.S. government just reclassified silver as a critical mineral. The designation isn't symbolic, it has teeth. It means Washington is admitting silver is essential for national security, industry, and the future economy. Solar panels, EVs, electronics, silver is in everything. By calling it critical, they've effectively put a floor under the price. So when people tell me $100 silver is crazy, I laugh. What's crazy is thinking the most undervalued, most indispensable asset on the planet can stay suppressed forever. Now let's zoom out. For months, we've heard the chatter about tariffs. People say this rally is tariff-driven. I've said from the beginning, no, this isn't about tariffs. This is about reshoring. It's about the recognition at the highest levels that the world is moving away from treasuries. from dollars, from paper promises. The big money knows it. The biggest traders in the US are accumulating. Sovereign wealth funds are accumulating. Central banks are accumulating. Think about what China is doing. They're the second largest silver producer in the world, yet they're flying around Latin America, buying doré directly from miners, paying double what Western buyers will pay, then shipping it back to China for refining. Why would the second largest producer need to scour the globe for more supply if silver were just some irrelevant rock? They know what it is. They know what's coming. To me, silver today feels exactly like gold did a year ago. Remember when gold was stuck in that $2,100 to $2,200 range? Everyone was saying it can't break out. It consolidated, built energy, and then when it broke, it never looked back. Gold is now over $3,600. Silver is in that exact position right now. Coiling, consolidating, ready to burst through. And here's where I get fired up. Silver isn't just an opportunity, it's the most asymmetric opportunity of a generation. Low downside, enormous upside. It's rare to find an asset with that kind of profile, and yet here we are, staring at it. What makes it even more compelling is that this rally isn't being driven by the public. Not yet. This is institutional, sovereign, big money demand. The public hasn't woken up. Imagine what happens when they do. Imagine the mom-and-pop investors piling in after silver clears $50. Imagine the Reddit crowd discovering physical silver the way they discovered GameStop. We haven't even scratched the surface of retail participation. So yes, the drivers are obvious. Big money is waking up. Central banks are weaving gold back into the monetary fabric. And now even Washington admits silver is critical. You add it up and it's clear. This isn't a blip. This is the beginning of a secular shift.
I mean, the big money is waking up to it, no question. And when I say big money, I think there's a duty when you have that kind of money to think. And I'll tell you that, and I mean, I'm serious about this. Where do you put your money at a certain point is very difficult, right? You got interest rates that on the short term, the very short term interest rates, which are coming down. I think you'll see the opposite on the 10-year. Will move the other direction, just like it did before, just like we see in London, where they've lowered rates 7 or 8 times, and yet their 30-year treasury is pretty darn well near its all-time high. The bond market controls the back end, but I wouldn't buy the back end anyway. I would own some 6-month treasuries or shorter duration, and those are coming down. Where do you put your money when inflation, the real level of inflation, is far greater than the interest that you're receiving for something as safe and liquid as a treasury? What happens if Trump gets his way and they lower rates 200 basis points to 2%? And the CPI, which is at 3.1% right now, is actually higher than the rate that is stated. The big money won't stand for that. We know that the CPI, because you've had John Williams on this show, will tell you it's 11% right now. Add an 8 to it, the way it used to be measured before they changed it. Point of it is where do you put your money? Stocks at all-time highs, bonds at not quite all-time highs, but losing demand rapidly. So much so you create something called the Genius Act, which it is kind of diabolically genius, to create synthetic demand for U.S. treasuries because the organic demand is waning. Where do you put it? You put it in real estate at all-time highs. You put it in banks that are over-leveraged and undercapitalized, where you are now a unsecured general creditor with bail-in laws. So yeah, I mean, I think there will come a moment where the public at large realizes this, but the big money is asking these questions every day. What do I do with all this money? And no one would have ever thought that having that kind of wealth would be such a pain in the ass, such a difficult thing to safeguard. And as you get older, you're more concerned about protecting than you are making, because, you're thinking of your children and your grandchildren, and how do I pass it on appropriately. Interest rates spike in an environment where there's that black swan. Well, the banks are in trouble, the insurance companies are in trouble, the bond market's in trouble, the stock market's in trouble, real estate's in trouble. Where do you go? And I think people are realizing this, and it's kind of a softball question for a guy that owns a precious metals company, but if people haven't figured out by now that I try to be as genuine as humanly possible, that I do as I say, they never will believe me. I will just simply say, to me, there are very few places where I think you can safely keep your money with a high degree of liquidity, where the biggest money in the world is showing you through their actions where they're going. And I think you will see that public catch on. But typically, the big money, well, they do this in the cover of darkness, where you got guys like, Jim Cramer, moron, saying, it's too speculative, it's frothy. They're not looking at this the right way, and they're not really part of it. But there are a lot of people who are clued in and understand where we're going and what's happening, that are buying gold and silver as a life raft. And that's the way that I look at it, but not just for an emergency, right? It's for an opportunity as well. And maybe having that dry powder in the form of something that is keeping its purchasing power against a dollar that's down 11% this year and gold up over 40.
Now let's go deeper, because this isn't just about supply and demand. It's about the entire financial system losing credibility, about trust itself evaporating in real time. For decades, U.S. treasuries were the rock of the global system. They were risk-free. Central banks from Beijing to Berlin built their reserves around them. But now that bedrock is crumbling. Foreign buyers are stepping away. China has been a consistent net seller of treasuries. Russia dumped nearly all of theirs years ago. Even Japan, historically America's biggest foreign financier, is trimming holdings to defend its own currency. When your best friend quietly starts leaving the poker table, it's time to ask, who's left to buy your chips? The uncomfortable answer: nobody. And Washington knows it. That's why we're seeing gimmicks like the so-called Genius Act. Diabolically clever schemes to funnel synthetic demand into treasuries, because the organic demand is gone. Think about that. The most liquid market in the world now needs artificial life support. Meanwhile, the Social Security Trust Fund is no longer a buyer. It's a seller forced to liquidate treasuries to cover shortfalls. The Fed itself is technically still reducing its balance sheet, not adding. That leaves the banks. But if banks are pressured to absorb more treasuries, that means fewer loans to the private sector. It crowds out growth. It starves the economy. This isn't stability, it's triage. And triage always leads to the same place: the Fed stepping back in as the buyer of last resort. More quantitative easing, more printing, more currency debasement, which of course is rocket fuel for gold and silver. Let's talk about inflation. Official CPI is 3.1%. Shadow Stats has it closer to 11%. And your own eyes tell you it's even worse. Go buy a week's worth of groceries and then tell me the Fed has inflation under control. Gas, rent, healthcare, insurance, education, all spiraling higher. The Fed talks about anchoring expectations. Well, here's the anchor. Every paycheck feels lighter, every bill feels heavier. That's the reality. Here's an example I like to use. In 1978, a student with a summer job at minimum wage, $2.65 an hour, could earn around $1,378. Tuition at a public university was $688. One summer paid the bill. Today, forget it. Students are buried under mountains of debt. But if that student had bought gold in 1978, at $193 an ounce, that summer job bought 7 ounces. Today, those 7 ounces are worth $26,000, more than enough to cover tuition at most public schools. That's the difference between real money and fake money. And silver? Silver is about to write its own version of that story. We've got the 45-year cup and handle pattern. We've got lease rates screaming shortage. We've got Washington reclassifying silver as a critical mineral. And we've got sovereign giants scooping it up while the mainstream yawns. Goldman Sachs is putting $4,000 as a base case for gold, with $6,600 not off the table. That's Goldman Sachs, not Zero Hedge. When the most establishment bank on Wall Street is publishing those numbers, you know the private conversations are even more aggressive. But what happens when silver clears $50? That's the magic number. Once it breaks, there's no resistance. The next stop is $96, maybe $100. And from there, who knows? Triple digits aren't crazy. They're expected. And here's the thing. This rally still doesn't include the public. The average investor is still hypnotized by the NASDAQ and Bitcoin. Which, by the way, let's talk about Bitcoin. Remember the marketing? Digital gold, gold 2.0. The problem is, when you actually measure it in gold terms, Bitcoin has underperformed badly. Over the last 4 years, Bitcoin priced in gold is down 15%. Meanwhile, gold is up over 40% just this year. Silver's up nearly 50%. Miners have doubled. Which one is the real store of value? This is why I believe you're going to see a rotation, not just out of treasuries, but out of Bitcoin. Investors are going to look at the performance gap and start shifting into gold ETFs, then into miners. The GDX and GDXJ have already hit levels not seen in over a decade. And here's the kicker. Miners are now outperforming gold, and silver is outperforming gold. That's confirmation. That's what was missing before. The skeptics used to say, well, miners aren't confirming. Wrong. Well, silver isn't confirming. Wrong. Now they are. This is the real deal. And yet the mainstream media remains silent. CNBC barely mentioned gold miners hitting all-time highs. They'll scream about Nvidia at $1,200, but not a peep about Barrick Gold jumping 10% in one day. It's almost funny. If you want to hide the best-performing sector in the market, bury it under endless AI hype. But the smart money isn't fooled. Central banks bought a record 1,136 tons of gold in 2022. 2023 wasn't far behind. The BRICS nations are openly talking about a gold-linked settlement system. Russia and China are already trading oil and gas in yuan and rupees, not dollars. Saudi Arabia is entertaining deals outside the dollar. The writing's on the wall. The world is de-dollarizing. I saw a tweet the other day that nailed it. The BRICS aren't buying gold because they're bored. They're buying gold because they're done funding U.S. deficits at Sound Money Ally. That's it in one line. And when the public finally wakes up, when they finally see gold at $4,000 and silver north of $75, it's going to be chaos. Premiums will explode. Inventory will vanish. People will line up around the block to pay 5 times what they could have paid today. This is the cycle. Big money moves first, quietly, under cover of darkness. Then the headlines shift. Then the retail crowd piles in, late, desperate. By then, the easy money is gone. The only question is, are you going to be the smart money or the desperate money? So here's my advice. Don't wait. Don't wait for CNBC to give you permission. Don't wait for Jim Cramer to change his tune. Don't wait for your neighbor to brag about his first silver coin. By then, it's over. Gold and silver are not just assets. They are life rafts. They are opportunities. They are asymmetric bets in a world where everything else, stocks, bonds, real estate, fiat currencies, is a symmetric disaster. Your Starbucks latte hasn't doubled in size. Your grocery cart isn't any fuller. But your bill is. That's the reality of fiat. That's the reality of trusting central banks. And that's why real money, gold and silver, is your best protection and your best opportunity. So stack, accumulate, hold outside the system, because when the reset comes, and it's already begun, you'll want to be holding ounces, not IOUs.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.